Let's get to some market stuff and have some fun, which is the CPI. The CPI came out, and remember all the economists, Daniel? Tariffs! It's going to impact us in April. It's going to impact us in May. It's going to impact, you're going to see the effects of it in June. All the inflation's going to go through. All these economists warned us, this is the third month in a row, that inflation is going to creep into these numbers, and inflation continues to go lower and lower. Shelter, the biggest component, so its smallest increase since 2021. It came in much lower than expected. Inflation is actually crashing. That is a fact. If you look on any chart and watch over the past 6 months, 7 months, inflation is absolutely crashing. And it's funny when I bring up economists, because economists also said that, we're going to see 6 rate cuts. All these rate cuts are coming, right? This is about 9 months ago. They're coming. They're all going to come. All these rate cuts. Then it was 5. Then it was 3 this year. And we still have none with, I think there's 4 meetings left. I'm not including the meeting. I believe it's a week from now. So 4 meetings left before year end. So the most we would see is 4 unless we get a 50 basis point cut. And I'm not ragging on them because, most economists I don't pay attention to. 99% I don't pay attention to when it comes to forecasts, especially when they try to talk about the stock market. You should never pay attention to them. But I will say this, you need to pay attention because forecasts are everything. And that's what the stock market is trading on. And when I look at what's going on with interest rates, after this, we saw Trump come out with a tweet again telling Powell, we got to lower by 1%. And it's really important for our deficits and less interest payments, which I think are $1 trillion now, just in interest on our debt, which is insane. When I look at Powell, Powell's only concerned about 2 things, right? He's concerned about the job market and he's concerned about inflation. That's it. Inflation's in check and the job market's very strong. He's in a perfect position to go on vacation and do nothing. And not only that, it's nice to be in this kind of market where you have this giant, massive bazooka that have stocks slow, the economy slows, and yes, I said stocks because it's not just the economy, because believe me, the Fed pays attention to that stuff, and so does the president, obviously. You have this bazooka where they can lower rates considerably because they haven't lowered rates yet, going into a lot of positives over the next, that we're going to see tremendous positives that we're going to see over the next 9 months. But what are your thoughts on a CPI? Does it impact anything? We saw the 2-year come down, so yields are starting to come down. Seems like things are much better than everyone was forecasting, where we're supposed to see inflation rise a lot more because of these tariffs.
The expectations are important because when you hear commentators talk about, hey, inflation expectations for the consumer, you hear these consumer uncertainty and all this, these reports out there, and they are high and they do impact because if you get into this habit, it's just like the wealth effect. When your stock market's going up and you're looking at your account and your stocks are at all-time highs and you're seeing your money increase, you're much more likely to go out and spend money in the world. And everybody understands that. Money is emotional. We've been pounding the table on that. What's wild here is that you have this dichotomy here between you have good information, you have good data coming out right now. Everybody should be happy that inflation is down. Yes, there's uncertainty. Yes, there's worries. Yes, there's unknowns. But what I hope the individual investor takes away from this is just how pathetic and worthless economists and media are. Because today on CNBC, and I'm not even going to name who it was because they don't deserve it, but it was hilarious and pathetic at the same time. And if I didn't have such a calmness about me, Frank, I would be upset. Yeah. Because this inflation data comes out and they can't, I get it. People hate Trump, so therefore anything that's good under Trump is bad. And the same old song and dance is, hey, you know what? Just wait. It's going to get worse because tariffs haven't made their way through. And there's a lot of truth to that. Tariffs have not made their way through the entire economy because they've been on pause, they've been rearranged, they've been negotiated, whatever. Who knows? But this mindset of, hey, it's going to get worse next month. Just wait. Hey, it's going to get worse next month. The impact on that to individual investors, in my opinion, hopefully is not to be nervous and get out of the market. I think that's what a lot of people are doing, and that's why you're seeing a lot of people miss out on gains. I just think it's a great example of the economy is not that difficult, people. Just tune out the media. We're getting good inflation data now, but that doesn't mean it's going to continue. But you have to live in the now in the markets. And what's hilarious, Frank, and I totally disagree that Fed Chair Powell is in a position to do nothing. Fed Chair Powell is getting exposed for the politician he is. Because again, you cut rates before the election last year when market, asset prices, everything was booming all-time high. Now you refuse to when your own measures, the PCE, is getting down close to your target, and you're on record of saying you can't wait until it actually hits your target. It's all a show. It's no different than the riots burning down LA. This is a character and theater. Just enjoy the show.
I mean, look, you're not seeing any cracks at all. Right? And anything. The bond market is seeing yields pull back a little bit, hold steady, pull back a little. So, sitting on your hands right now is not a problem when you have a strong market and inflation is coming down by itself. They thought tariffs would put a dent in that, but it hasn't. And maybe it will in the future, but they were predicting for the last 3 months that it would. right? And it still hasn't happened. It still
But that's the
hasn't shown up.
narrative today. If you watch anything on mainstream media today, it's, hey, wait till next month. They're going to get a lot worse.
That's what they said every single month.
And they might, exactly. And that's worthless. That's why they're on TV.
Now I'm going to share a couple of things with you guys, and I shared with, I don't know if I did the earnings segment. I think I did that last week. I don't know if that was for Wall Street Unplugged Premium. Guys, if you want to subscribe to Wall Street Unplugged Premium, it's $10 a month, and we're getting lots of subscribers, and lots, because we have, great stock picks in a portfolio, and it's a separate podcast that Daniel and I do every Thursday with more details, right? So we talk more in depth about stocks and everything. You can find that offer on our website. I think it's $100 for the year. And the reason why I'm saying that is because, we break down a lot of topics sometimes. Sometimes I'll forget if it's a free podcast or if that one. But when we're looking at earnings, and the earnings growth that we're projected to see is pretty amazing. And it's not just earnings growth, because if you're looking, and what I like to do is look 9 to 12 months from now, what are we going to see with the marketplace? Okay, we thought tariffs would impact a lot, and that caught us a little bit by surprise, and we thought that the market wouldn't come down as much because I didn't think Trump would try to negotiate tariffs with every single country at the same freaking time, which is insane, right? Because companies cannot operate like that. And that hurt, and it hurt the bond market, and Bessent was like, tap Trump on his shoulder and said, look, you got to relax a little bit. And certainly they did. And you saw what happened in the Middle East. And it's going to happen pretty much in Europe. It's going to happen in Canada. It's going to happen in Mexico as well. It's going to be, very favorable where everybody wins. And those are going to be positive cows instead of saying tariffs are going to be negative. Now we just heard from China that, hey, we just signed a deal. Trump said with rare earths and stuff like this. So much you could do under the table with China to make this work. And, it is going to work. It's just a matter of, how stubborn they are when it comes to Xi and Trump. But if you're looking at tariffs, that's going to wind down. Right? It's a risk that's going to be temporary, and even if it does cause inflation, it's going to cause a one-time inflation bump. It's not like this constant inflation and constant raising prices. You're looking at lower rates. Significantly lower rates are coming. Maybe they don't come right away. Maybe they don't come this year, but I could tell you Powell's term's up in May, and the next Fed who's going to get elected, next Fed president gets elected by the president, which is Trump, he's going to make sure that he's going to lower rates considerably. And Trump's not talking about lowering by 25 basis points, 50 basis points. It's several points. You're going to see much lower taxes due to this bill. You could hate the bill. You could say this bill is bullshit. You could agree with Elon Musk and, oh my God, it's just crazy. That's fine. That's good. I don't care what side of the aisle you're on, whatever you believe. Passing the bill is great for equities, is great for asset prices. You're going to see less regulation for banks, right? So more money flowing into the economy that wasn't allowed to flow into the economy, which is huge. More lending. Again, that strong earnings per share growth, which we saw where people are like, markets are so expensive right now. They're more cheaper than they were the past 5 years when accounting for growth. That's what I broke down last week. Okay, when people say, well, the market's expensive, you can say it's not as expensive as it was the past 5 years, and the market did great, because it's not. Because we're trading at a 21 PE right now, and we traded at 20 on average for the last 5 years, except we saw 10% earnings growth over that time annually. We saw 13% earnings growth year over year from this quarter that just reported, and through 2026, we're going to see 13.5% growth. That's what's expected. So we're growing much, much faster and only trading a little bit higher than multiple. It makes us kind of cheaper. Not kind of, it does make us cheaper than we were. Now you're throwing in the government spending, which I just mentioned, and you hate this. You hate that the bill might pass. You hate the government spending, and I get it. You can hold up a sign and say whatever the hell you want. This is about your family. This is about money. Okay, so put the personal shit aside. It's going to fuel asset prices, especially stocks. So will we go straight up? Absolutely not. Will I tell you to buy S&P 500? No, I wouldn't buy the Russell either, even though the Russell's really starting to outperform and all the small caps are doing fantastic right now. I would go to just individual stocks that are playing catch up. You notice how there's getting bids on Nike, bids on Starbucks, names that have gotten crushed before. We just saw a play, which is Dave & Buster's, which I love because the value of this company is 3x the real estate alone that they own compared to, and that's based on recent sales. They just sold a couple of their properties over the past 9 months. And it's a company where the earnings were crappy and the stock's up tremendously. It was up 7%. Now it's up like 16, 17, 18% because there's massive short covering. But you're seeing companies that underperform significantly, money starting to flow into them. So I wouldn't tell you to buy the major indices. I'm just saying this catch-up trade is here. You see more orders for Boeing. You're seeing industrials lead the market right now. Holy shit. Industrials are leading the market. Okay. If that's not a sign to be bullish. So will they go straight up? No, but we're still for the past 60 years in a buy the dip mentality. So even if we fall, if you see risks, if the China trade and tariffs goes to shit, you see the markets come down, add to your favorite positions. Okay, because the biggest trends when we're looking at unemployment is fine right now. We're looking at, no debt concerns and so the bond market. Yes, it's insane. And people are like, Frank, what are you talking about? How much money? I know you read a million articles, the world's going to fucking end. I know it's the same articles from the 70s, okay? And the 80s and the 90s. I get it. But more spending means that asset prices are going to go higher. And when you're able to do that while keeping inflation in check and keeping the job market strong, you could say very strong historically, but relatively strong the past couple of years, you're looking at a perfect environment for stocks. Again, you're going to see risks coming in and tariff announcements, stuff like that, but use it to your advantage. Buy some of your favorites. That's what we did. We were wrong on tariffs. However, we added so many positions. We really went all in when the market came down, and now we're doing fantastic, especially within AI. But a lot of these trends still exist. AI, cloud growing tremendously, blockchain technology, new regulation coming out. A lot of these exist, which make the market a really great place to be even now. And don't listen to anyone because it's not super expensive and you're crazy. It's less expensive when accounting for growth than it was over the past 5 years.
Way to go on highlighting the growth. One thing on the employment, you're right, there is no concerns on unemployment, but I do want people to watch this because I was very critical of the Biden administration, so I will carry that over to the criticism of the Trump administration. Frank, what I want people to pay attention to is the jobs numbers continue to come in higher than expected. There was 139,000 versus roughly 130 last year. Watch for the revisions. And Biden, we ranted on this in the past. I'm not going to go down that path. But there's been revisions, and there's basically revisions every single time. But you want to pay attention to those because they were massive during the Biden administration, which misleads on the employment side. Now, January was a partial reading, but February and March have both been revised lower. Not to a crazy amount, but it's something that I think everybody should pay attention to because that, not only when employment rises, because they have this dual mandate that they talk about with prices and jobs, but Frank, it's how quickly that will change. So it's not necessarily that I'm just using this as an example. I don't mean to make light of this, but if unemployment goes from 4.2 to 4.8, Frank, there's a big difference between if that takes a year, year and a half, or 4 months. You know what I mean? Just to make an example out of that. So just pay attention to the revisions because we pounded the table on that during last time, and it's still continuing along with government spending, which is why you don't want to fight that wave that's powering asset prices higher.